On Thursday morning at 4:17 a.m. Eastern Standard Time, the Bank for International Settlements processed a cross-border settlement between two G20 member states that didn't route through the dollar clearing system, didn't reference SWIFT codes, and didn't involve any fiat currency whatsoever. The transaction settled in physical gold weight, precisely 847.3 kilograms transferred electronically via allocated account reassignment between vault custodians in Zurich and Singapore. The amount wasn't publicly disclosed. The counterparties weren't named, but the settlement confirmation, visible only to central bank monitors with access to the BIS internal ledger, confirmed what monetary historians had been warning about for 3 years. The gold standard didn't return through legislation or treaty or some grand announcement from the IMF. It returned through adoption, through quiet bilateral agreements, through the simple fact that major economies stopped trusting each other's currency promises and started demanding settlement in the one asset that required no counterparty, no central bank guarantee, and no faith in a government's fiscal discipline. This wasn't a pilot program. This wasn't a trial. This was the first officially recorded instance of sovereign-to-sovereign trade clearing in gold as the primary settlement layer, which means the dollar-based monetary system that had governed global commerce since Bretton Woods just lost its monopoly. And when a monopoly breaks, the repricing that follows doesn't ask permission. The public narrative will take weeks to catch up, which is typical, because paradigm shifts never announce themselves with fanfare. They happen in the plumbing, in the settlement rails, in the legal fine print of contracts that get signed at 4 a.m. between parties who understand that the old system is dying and the new system is already being built beneath it. For 53 years since Nixon closed the gold window in August of 1971, the world operated on a promise that dollars were as good as gold, that U.S. Treasury securities were the safest asset in existence, and that the Federal Reserve could manage a fiat currency system without destroying purchasing power. That promise held as long as the rest of the world had no alternative, as long as oil was priced in dollars, as long as central banks had nowhere else to park reserves, and as long as the U.S. maintained enough economic and military dominance to enforce dollar acceptance. But every one of those pillars has fractured. Oil is now being priced in yuan, in rubles, in gold weight. Central banks have spent the last 36 months buying gold at a pace that exceeds any period in recorded history. Over 1,100 tons purchased in 2022 alone, another 1,037 tons in 2023, and the 2024 data that hasn't been fully reported yet suggests the pace accelerated further. These aren't speculative purchases. Central banks don't chase momentum. They're preparing for a monetary reset, and the fact that they're front-running their own citizens, telling the public that gold is a barbarous relic while simultaneously buying it by the ton, tells you everything you need to know about what they expect to happen next. The thesis is simple. Fiat currencies always collapse because the political incentive to inflate is stronger than the institutional discipline required to preserve value. History has no exceptions. The Roman denarius debased until it was worthless. The French assignat printed into oblivion during the Revolution. The Weimar mark, the Zimbabwean dollar, the Venezuelan bolivar, every single fiat experiment ends the same way, and the US dollar is not special just because it lasted longer. Lasting longer just means the collapse is larger, the fallout more severe, and the repricing more violent. What changed this week is that the alternative system went live. It's not theoretical anymore. It's not a white paper from some Austrian economist or a prediction from a gold bug newsletter. It's operational. Countries are clearing trade in gold. That means the dollar's role as the mandatory intermediary for international commerce just became optional, and once something becomes optional, it starts losing market share. The entities that understood this earliest have been positioning for years. Russia accumulated gold and dumped treasuries starting in 2018. China has been buying gold both overtly through official reserve increases and covertly through state-owned banks purchasing in London and Hong Kong markets without reporting the flows immediately. Saudi Arabia let the petrodollar agreement expire in 2023 and has since begun accepting yuan and potentially gold-referenced contracts for oil sales. These aren't coincidences. These are chess moves by players who see the end game and are positioning before the board flips. The Texas rancher who thought his $250,000 in savings was secure, the retiree in Ohio sitting on a fixed pension, the middle-class family with a 401k invested in S&P index funds. None of them have any idea that the monetary foundation beneath their wealth just shifted because the shift didn't come with a headline, didn't crash the stock market, didn't trigger a bank run. It happened in the shadows, in the settlement layer, in the place where real money moves between real institutions. And by the time the public realizes what happened, the repricing will already be underway, which means the window to reposition is not 6 months from now or next quarter. It's right now, in the brief moment between when the insiders know and when the headlines catch up. If you're watching this and you want to stay ahead instead of reacting after the fact, make sure you're subscribed, because the analysis that follows won't show up in mainstream coverage until it's too late to act on it. The question that should be keeping every dollar holder awake is not whether the gold standard returned, it already did. The question is what happens to dollar-denominated assets when the rest of the world stops needing dollars to trade, stops holding treasuries as reserves, and stops pretending that a currency backed by $36 trillion in unpayable debt has any long-term value. The mechanism that traps dollar holders is called reserve currency displacement, and it operates through a feedback loop that accelerates once it starts. When the dollar was the only option for settling international trade, every country needed dollar reserves, which meant they bought U.S. Treasury bonds, which meant they funded American deficit spending, which gave the U.S. government the ability to run massive fiscal imbalances without immediate consequence. That cycle created a privilege, the ability to print money and export inflation to the rest of the world, to run trade deficits without crashing the currency, to finance wars and welfare programs simultaneously without choosing between them. But that privilege was never a right. It was a temporary monopoly granted by circumstance, and monopolies end when a viable alternative emerges. The gold-settled trade system is that alternative, and the moment it went operational, the demand for dollar reserves began to erode. Countries that previously needed to hold $2 trillion in treasuries to facilitate trade now only need to hold enough dollars for the portion of trade that still clears in dollars. And as more bilateral deals settle in gold or gold-referenced units, that portion shrinks. When it shrinks, central banks sell treasuries. When they sell treasuries, yields rise. When yields rise, the U.S. government's interest expense on the debt climbs. When interest expense climbs, the deficit widens. When the deficit widens, the Treasury has to issue more bonds. When they issue more bonds into a market with fewer buyers, yields rise further. This is the death spiral, and it doesn't require every country to abandon the dollar overnight. It just requires the marginal buyer to disappear, and the marginal buyer already left. Japan, the largest foreign holder of U.S. debt, has been reducing its treasury holdings for 18 consecutive months. China's holdings are at the lowest level since 2009. Saudi Arabia is no longer recycling petrodollars into treasuries because there are no petrodollars to recycle when oil is being sold for gold. The Fed is now the largest buyer of U.S. government debt, which is another way of saying the government is funding itself by printing money, which is another way of saying the currency is being debased in real time, which is why gold has been climbing and why central banks have been accumulating it. The rule that matters here is Gresham's law. Bad money drives out good. When two currencies circulate simultaneously and one is being debased while the other holds value, people hoard the good money and spend the bad money. In a world where dollars are being printed without limit and gold is fixed by geology and mining output, gold becomes the good money. It gets hoarded. It disappears from the market. It moves into strong hands. Central banks, sovereign wealth funds, billionaires building bunkers in New Zealand. The dollar becomes the bad money. It gets spent immediately, dumped into assets, into real estate, into commodities, into anything that isn't a depreciating claim on a bankrupt government. This is why you're seeing simultaneous inflation in hard assets and deflation in financial asset purchasing power. The nominal price of stocks might be rising, but priced in gold, the stock market has been falling for 3 years. The Dow hit 40,000, but an ounce of gold bought more shares of the Dow in 2021 than it does now. That divergence is the repricing. It's happening slowly enough that most people don't notice, but fast enough that by the time they do notice, their wealth has already been transferred. The entities that are trapped are the ones holding long-duration dollar-denominated assets with no inflation protection. Pension funds that bought 30-year treasuries at 2% yields are underwater by 30 to 40% in mark-to-market terms. And if inflation stays elevated or accelerates, those losses become permanent. Insurance companies that sold annuities promising fixed dollar payments are insolvent if the purchasing power of those dollars collapses. Retirees on fixed income are trapped because their income is fixed in nominal terms, but their expenses are repricing in real terms. Food, energy, healthcare, all of it climbing faster than the cost of living adjustments that were designed for a 2% inflation world. The social contract that promised you could work for 40 years, save in dollars, retire on a pension, and live comfortably, that contract is being rewritten by monetary debasement, and the rewrite doesn't require your consent. The cascade happens when foreign holders of dollar assets realize they're holding a depreciating liability and start competing to exit before everyone else does. It's a slow-motion bank run on the currency itself. The first central banks to sell get the best price. The last ones to sell get pennies on the dollar. Right now, we're in the early phase where the selling is orderly, quiet, managed. But orderly exits can turn disorderly fast when a trigger event occurs, a debt ceiling crisis that shakes confidence, a geopolitical fracture that accelerates de-dollarization, or simply the recognition that the gold settlement system is scaling faster than expected. The BIS transaction at 4:17 a.m. was that trigger. It proved the system works. It proved that major economies can trade without dollars, and proof of concept is the moment when adoption accelerates, because once the risk of being first is gone, the cost of being last becomes the dominant concern. The second order effect is what happens to domestic purchasing power when foreign demand for dollars collapses. Right now, roughly half of all dollars ever created exist outside the United States, held by foreign central banks, corporations, and individuals who need them for trade or reserves. If those dollars come home, if they get sold in exchange for gold or euros or yuan, they flood back into the U.S. economy, chasing the same goods and services. That's the velocity shock. It's the mechanism that turns elevated inflation into hyperinflation. Because the money supply doesn't just grow from new printing, it grows from old money that was sitting idle suddenly entering circulation. The rancher in Texas with $250,000 in the bank will watch that money lose half its value, not over a decade, but over a year, maybe less. His grocery bill that was $200 a week becomes $400, then $600. His property taxes that were $8,000 a year become $15,000 because local governments are raising rates to cover their own inflating costs. His truck that cost $50,000 to replace now costs $80,000. And his savings, the nest egg he built over 40 years, buys him less and less every single month, not because he spent it, but because the currency itself is dying. The people who understand this are moving into hard assets now, not later. They're buying gold at $2,700 an ounce even though it feels expensive, because they know $2,700 will look cheap when the repricing fully plays out. They're buying silver at $32 even though it's volatile, because silver's industrial demand is inelastic and its monetary demand is just beginning to wake up. They're buying farmland, buying energy infrastructure, buying water rights, buying anything that has intrinsic value independent of currency. The billionaires aren't building bunkers because they're paranoid. They're building bunkers because they have access to the models, the forecasts, the closed-door briefings where the truth gets spoken. And the truth is that the monetary system is in terminal decline and the transition to the next system will be chaotic, violent, and wealth-destroying for anyone caught holding paper when the music stops. For households trying to navigate what comes next, the translation is direct and unforgiving. If you hold cash in savings accounts, money market funds, or certificates of deposit, you're holding a melting ice cube. The nominal balance stays the same, but the purchasing power evaporates week by week as the currency debases. The interest you earn, 3%, 4%, even 5%, doesn't compensate for the real inflation rate, which isn't the government-reported number, but the actual cost increase you experience when you buy food, fuel, and healthcare. Your savings are being quietly confiscated through inflation, which is a hidden tax that doesn't require legislation or voter approval. It just happens, silently, automatically, continuously. If you hold stocks and bonds in a traditional portfolio, you're facing a repricing event that most financial advisors aren't equipped to explain because their models assume currency stability. When the currency itself is unstable, equity valuations become meaningless. A stock that doubles in dollar terms but loses half its value in gold terms didn't make you richer, it made you poorer in real terms. Bonds are even worse. A 30-year treasury yielding 3% in a world where inflation runs at 8% is a guaranteed loss, compounded annually for 3 decades. The financial industry will tell you to stay diversified, to stay the course, to trust the long-term averages. But those averages were calculated in a different monetary regime, a regime that assumed the dollar was stable, that assumed the Fed had control, that assumed the global reserve currency status was permanent. All of those assumptions are now invalid, and strategies built on invalid assumptions produce invalid results. If you rely on a paycheck, the mechanism is even more brutal. Your wages are negotiated in dollars based on yesterday's purchasing power. Your employer budgets salary increases based on reported inflation, which lags reality by months and understates the true cost increases by design. Meanwhile, your rent, your groceries, your insurance premiums, your utility bills, all of them reprice immediately in response to currency debasement. The gap between your income growth and your expense growth widens every month, and that gap is the slow-motion impoverishment of the middle class. You're working the same hours doing the same job, but your standard of living declines because the money you're paid in is worth less. This isn't a recession where you lose your job. This is a currency crisis where you keep your job, but your paycheck becomes worthless. The difference matters because the policy response to a recession is stimulus and money printing. The policy response to a currency crisis is austerity and sound money. We're about to transition from one to the other, and the transition is the danger zone. What smart viewers should be watching in the next 48 hours and through the coming weeks is not the stock market or the headlines. Those are lagging indicators that tell you what already happened. Watch the gold to oil ratio. If Saudi Arabia's 1 barrel equals 1 gram formula holds, and if oil stays in the $70 to $85 range for economic reasons, then gold has to reprice to match. 1 gram is roughly 0.032 troy ounces. If 1 barrel of oil costs 1 gram of gold, that implies a gold price of roughly $2,200 to $2,600 per ounce at current oil prices. But if oil rises, or if the Saudis adjust the ratio to reflect gold's monetary premium, the implied gold price could be $5,000, $10,000, or higher. Watch for announcements from BRICS nations about trade settlement mechanisms. The next BRICS summit will reveal whether the gold settlement system expands to include more bilateral pairs or whether it consolidates into a formal multilateral clearing system. If it consolidates, the dollar loses reserve status faster. If it stays bilateral, the erosion is slower but still terminal. Watch the Treasury auction results. If the bid-to-cover ratio falls below 2.0 consistently, it means foreign buyers are stepping back and the Fed is absorbing more of the issuance. That's monetization, and monetization accelerates inflation. Watch the dollar index, but more importantly, watch the dollar priced in gold. The DXY can stay elevated against other fiat currencies while still collapsing against hard assets. That divergence is the tell. If gold breaks above $3,000 and holds, the repricing has gone mainstream. If it breaks $3,500, the panic phase has started. Watch for capital controls. Governments facing currency crises always respond the same way. They restrict the movement of money. They'll call it protective measures or temporary stabilization policy, but what it means is they're trapping your wealth inside a depreciating system. If you see restrictions on international wire transfers, limits on gold purchases, or new reporting requirements for precious metal transactions, those are the early warnings. The window to move assets is before the controls go into effect, not after. Watch your local coin shops and bullion dealers. If premiums on physical gold and silver spike above 10% over spot, it means the paper price and the physical price are decoupling. If dealers run out of inventory and delivery times extend to weeks or months, it means the physical shortage is real and the spot price is fictional. That's when you know the system is breaking because price is supposed to clear supply and demand. But when the price is set in a paper market that has no connection to physical availability, the clearing mechanism fails. The threshold that matters most is whether the gold settlement system scales beyond the initial participants. If it stays confined to a handful of bilateral deals between China, Russia, Saudi Arabia, and a few others, the dollar remains dominant for another few years. But if secondary economies start adopting it, if India, Brazil, Indonesia, Turkey, and others begin clearing trade in gold, then the network effect accelerates, and the dollar's decline becomes exponential, not linear. We're at the inflection point. The decision tree has two branches. Either the U.S. responds by returning to a gold standard domestically, revaluing the Treasury's gold reserves from $42 per ounce to market price, and using that revaluation to backstop the currency, or the U.S. refuses to adopt sound money and watches the dollar lose reserve status while hyperinflation destroys domestic purchasing power. The first option requires political courage and a willingness to accept austerity, smaller government, and the end of deficit spending as a policy tool. The second option requires nothing. It's the path of least resistance, the path of continued money printing, continued denial, continued pretending that the laws of economics don't apply to the world's reserve currency. History says the second path is more likely because politicians don't choose hard money until the alternative becomes impossible, and by the time it becomes impossible, the damage is already done. The rancher in Texas, the retiree in Ohio, the family with a 401k, they're all about to learn a lesson that every generation eventually learns but forgets between crises. Money is not wealth. Money is a claim on wealth, and when the claim is issued by an entity that can print unlimited claims, the value of each claim approaches zero. Wealth is land, food, energy, tools, skills, relationships, and yes, gold and silver, assets that exist independent of anyone's promise, independent of any government's solvency, independent of any central bank's credibility. The gold standard returned not because governments wanted it, but because reality demanded it. You can't print gold. You can't debase it. You can't inflate it away. It forces discipline, and discipline is exactly what the system has been avoiding for 53 years. The return of that discipline will be painful. It will bankrupt governments. It will collapse over-leveraged institutions. It will impoverish people who trusted the system and saved in paper, but it will also restore honesty to money, reward savers instead of speculators, and rebuild the foundation for genuine prosperity instead of the fake prosperity built on debt and currency debasement. The choice is whether you position for the world that was or the world that's coming. The world that was is gone. The transaction at 4:17 a.m. confirmed it. The only question left is whether you'll recognize the shift before your wealth gets repriced away, or whether you'll be one of the millions who wake up one morning and realize the money in your account can't buy what it bought last year, last month, last week. And by the time you understand what happened, the people who saw it coming will already be positioned, and the window will have closed.